Okay, good afternoon, everybody. Thanks for joining us. I'm Anthony Landahl, Managing Director of Equilibria Finance, and I'll be your host today. And I'm pleased to say that joining me is Josh Masters from Buyside, and we'll be conducting this webinar on using cutting-edge technology to uncover the next property hotspots. Firstly, just a general advice warning. This is obviously of a general nature. It's not specific to anyone's particular circumstances, and it doesn't take into account personal objectives and financial situations. So this is just general advice. So firstly, some housekeeping on the way through. This is an interactive webinar. So if you have got a question, please use the Q&A tab, or if you have got a technical issue, please just use the Q&A tab. So that we can assist you or answer your questions on the way through. And that you'll find that either at the top of your screen, or if you're on an iPad or on a computer, or at the bottom of your screen, or maybe up the top if you've got an iPad. So today's presenters, I'd like to introduce Josh. Some of you know Josh through some of the work he has done for you already. Josh is the director of Buyside. That's an independent buyers advocacy and agency specialising in helping their clients build wealth through residential property investment. They provide an end-to-end solution, handling everything from research, search of the best property deals, right through to negotiation and securing tenants for our clients. And Josh works up and down the East Coast, Sydney, Brisbane and Melbourne, and has been the author of property investment book, Why Property, Why Now, which I know a number of you have, and he's also featured on Sky Business a number of times. So Josh is always looking at different angles for investors, where to invest in the market, when and where to buy, and we're pleased to have Josh here today and get his expertise, and he's going to share with us his experience and expertise in some of the challenges and strategies in overcoming purchasing the right investment property, and some of the opportunities and some of the cutting edge technology that's now available to Josh and his team. So Josh, I'll hand over to you at this stage, mate, to start the presentation. And as I said, if you've got questions, please put it in the Q&A panel. We'd be more than happy to answer them on the way through. So Josh, over to you.
Mate, thanks for having me. That was a fantastic intro. Can you hear me okay? Is everybody's online can hear me? If you have any sort of answers or queries coming through, as Anthony mentioned, just pop them in the Q&A. If you just write in the Q&A now that you can hear me, or that you can just give me a sign or an exclamation mark, whatever you want to do, just to let me know that everybody can hear me coming through okay. But look, Anthony, I thought before I jump into this, for those of you who don't know me and haven't worked with me before, to give you a little bit of background about who I am. I think it all started really when I was about 22. I was in university. I was saving a lot of money at the time, working tables down at Darling Harbour, and I was about to go overseas travelling indefinitely. And my dad said to me, "Look, Josh, why don't you take some of this money and invest in property before you leave, because whatever you take with you, you're going to spend." And he was very right. I did spend everything I took, but I did take his advice, and I actually bought this little property up near Byron Bay at the time. This was back in 1999. I bought in Byron Bay because they said at the time Sydney was too expensive. So if you can figure that was back in 99. A great time to buy regardless, because over the next 10 years, that property actually tripled in value. And I had been working hospitality for 10 years. I owned a restaurant at that time. And I quickly understood that that property had made me more money than I could have ever made or saved in my own job. And that's when I kind of realized and switched on to the power of investing in assets and having something underneath you. I subsequently went into property, but in design. I studied as an interior designer for about 6 years and did a lot of renovations and development work. And then went out into buying and selling my own properties, and subsequently got licensed to become a buyer's agent and help other people do the same thing. And that was about 7 years ago. And it's been my company for about 4 years now. And as Anthony mentioned, we've got offices along the East Coast now. And what I love about property is the freedom it gives me to do the things that I want to do by building assets and building equity underneath me to grow the lifestyle that I want to live. And what I love about doing this for other people is being able to give them the freedom either in retirement or with their children as we move forward. But the reality is that we are faced with a situation where only 1 in 5 people in Australia have invested in property. So it might sound familiar to you to talk about investing in property and what it does, but the fact is not that many people are doing it. And I think it's because I see a lot of people coming up against obstacles which they simply can't get past. And what I'd love to do here, Anthony, if it's okay with you, mate, I just want to sort of throw it out to the group here and say, you know, what's the hardest part that you found about investing in property? Because I get comments back all the time from other people about what they think, and I'm going to reveal those to you in the next slide. But I'd love to hear from the people online today what they found about the hardest part about investing in property is. So just type it into the question box there that's up in your top of the screen, up on the top tab. Just click on the Q&A bit, and you can type in straight into the answer box. So I might just wait here, Anthony, for this. Obviously, we can't see anybody.
As it comes through, so as it comes through, we'll be able to see those come through, mate.
Yeah, great. So don't be shy. Just reach out there. Just tell me what you think is the hardest part about investing in property today. Okay, so we've got a few coming through here. Look, I tell you, because I deal with so many clients, the majority of people that are coming to me have really 3 things that they're struggling with. So tell me if this resonates with you. First of all, you're not sure where to invest, right? Dominic's mentioned, thanks for mentioning, Dominic, admin is the most difficult. Like, I imagine managing the paperwork that's coming through, probably getting a loan across the line, which is a good segue into one of these other ones. People say the media says the market is falling. Is it the right time to buy? We're not sure where to invest, but is now the right time to buy anyway? And finally, the last one addressing that is that I can't borrow as much as I thought. Right, that's a big one right now. We've all obviously seen the Royal Commission findings coming out. That slowed up a lot of people. The banks are assessing expenses a lot more detail now, as Anthony, you can probably support. And a lot of people are saying, I simply can't borrow as much as I thought, which means I'm priced out of a lot of the markets that I thought I was going to be able to invest in. And what subsequently happens is that you end up looking like this guy, you know, feeling frustrated, getting emotional about it, and really just throwing your hands up in the air and going, you know what, it's all too hard. I'm just going to sit on the sidelines and wait to see what happens. So this kind of directs me into what we're going to talk about today. And the agenda is going to run like this. First of all, I want to really talk to you about a proven system that we found for identifying growth in today's markets. I want to talk to you about the results that we've had to date. And I want to talk to you about some of the opportunities that we have right now in the marketplace so that you can see for yourself what we're looking at as we speak. Is that okay? Does that sound okay, Anthony?
Sounds good. And I think as well, it'll be good to cover off on your way through the change from the traditional approach people have used finding an investment property, which I'm sure you'll work through. So, mate, get stuck into it.
Fantastic. Sounds good. Well, mate, look, what I'm going to start with is a bit of background around how this research has come about. And we've bought hundreds and hundreds of properties over the last 5, 6, 7 years, and we did develop a really thorough model that analysed a lot of the risks and how to identify growth in the marketplace. We look at transportation links, we look at new infrastructure coming in, we look at supply levels coming into the marketplace in terms of new builds, even down to vacancy rates, rental yields, etc. And all these things are great and identify growth hotspots. The problem was the missing piece of the puzzle was when this growth would take part. And we all know, for example, a train line might be going out to the northwest, rail links, and Castle Hill might get a new train line. But when is the best time to buy in those areas? And we teamed up with a research house late last year who had built this model over a 3-year period and had back-tested it over that period. And to give you a little bit of background about how they started, they actually kind of found the same frustrations that we did and took about 20 years of data, both on the economic front. So they looked at unemployment rates, they looked at wage growth, job growth, etc. And they also took historical prices. And they created this little tool that allowed you to create different parameters, almost as like a predictive formula to create your own predictions around whether particular areas would grow over time. So they sent it out to about 150 investors and they said, can you adjust this tool so that you can identify the best growth possible in the marketplace today and send it back to us? And basically they just sat back, took all these tools in and the formulas that these people had created, and they back tested them against 20 years of data. Then what they did was they took the best performing one based on the buy and sell prices over that time, and then they layered a level of artificial intelligence over it to refine exactly what was happening. And lo and behold, they came up with this formula that has really been very, very impressive. And I'm going to show you some of these, the results of this today. But what I want to dive into is how this model actually works. And I'm going to show you the sort of the back end of it without getting really too techie about it. I want to show you how these people actually identify growth markets today, because it is really eye-opening, and it's probably not what you thought. It does work on the very basic level that we've pursued in the past, in that it's a top-down level of analysis. So we look at all the suburbs across Australia first, then we dive into the particular streets within that suburb and the parameters that identify the best streets. And then we actually dive into the right property surrounding or in those streets itself to get the best outcome. So let's talk about suburb selection first. And as I mentioned, the key, the missing point here was when these suburbs were to take off. And as I mentioned, the first thing that happens within this equation was that there was an event or a cause for growth. Now, that cause could have been a new shopping centre, a new train station. It could have been a new contract being awarded. For example, Adelaide won the contract for the submarine, that $40 billion contract for submarine building. Now, that's the event, but then it's a question of, okay, timing. When are these people actually going to move into the suburb? And what they found was that once the event happened, people would rent in the area first. So we would see both rents and yields increasing at the same time. So rental prices and yields increased at the same time. From there, once people moved to the area, they were testing it out. The kids would start going to school, they'd get familiar with the area, they'd like it, they'd see the growth that was happening, and more sales would start occurring. All right, so now sales are starting to increase. Now, the final sort of linchpin in this is that the time to sell started getting quicker. And this is what we call, and we measure it with days on market. So days on market started falling. So for example, if you were in an area where it took 60 days to sell, and now you're in an area where it takes only 30 days to sell, you know that market is heating up. So in summary, what we saw is that people would move to the area first, they would rent and try it out, then they would buy the property that they were potentially living in or in the area, and those sales would start increasing at an exponential rate. And this is what we now consider to be the tipping point for markets that are going from buying markets into selling markets, right? Does that make sense? Anthony, still?
Yep. That makes sense, absolutely.
Fantastic. Mate, I've got a cracking image for you on this. and it came from our studies around the Hobart market. And this is the perfect way to describe how this tipping point actually occurred. So you can see that the Hobart market, for example, languished around those low points, 4 to 450s for some time. And look, you don't want to get into a market where it sits stagnant for 5 or 6 years because no one's making any money. You really want to start getting in at this point where, as you can see on the graph, it starts shooting upwards, this trajectory, this tipping point. And as you can see here, where it starts to turn orange, this is where the market was starting to turn from a buyer's market into a seller's market. Now, we see these things happening across different markets, and they might open a window for about 3 to 4 months, and then the market starts becoming what we call a seller's market, starts becoming hot. It's difficult to negotiate. It's hard to find good property. Sellers are demanding higher and higher prices. And this is what we've seen in markets across Australia over the last, umpteen number of years, but especially in probably Sydney and Melbourne for the last 5. So when we look at these suburbs across Australia, we're finding that all in all, there's probably...
Josh, just on that,
Sorry,
someone's just asked, is there a specific reason? Have you identified something in Hobart that created that uplift, I suppose, if you go back to that previous slide?
Yeah, absolutely.
What were the trigger points right there for West Hobart?
Yeah, what happened in Hobart was a number of things. And I'll have to preface this and say, we weren't with this company back in the 2015 mark. This was very early in the start. And they didn't release this model until only late last year because they really weren't sure how it would perform. They've had to backtest this data, but I can tell you from experience, from what I know about the Hobart market, they very much flipped their economy around and really started focusing on tourism. They really pushed out to the baby boomers market. They started promoting a lot of the food industry down there. The art gallery, which I think is called MoMA, I think, off the top of my head.
Mona, yeah.
Mona, yeah. And it's funny, I was actually seeing in the Qantas flight the other day and read this amazing article about this little town in Tasmania that had actually, it was almost a dying town, and these guys had come in and they were mountain bike riders, and they came in and transformed this town, and now they do rides out of this little town, and they do them through the countryside, and they stay at little campsites along the way in little cabins. And basically the whole town now is geared up for these mountain bike tours where one shop changes the wheels and does the punches and things, and the other shop sells bikes. The point being that the whole community is really transformed now towards tourism, and it's really picked up the local market in general. And I would say that's probably the event or cause that has caused this turning point to happen, long and short of it. Does that make sense?
Yep. No, I think that's a good answer, yeah.
So going back to the suburb analysis, there's about 15,000 suburbs across Australia. So the program dives in and says out of those 15,000, probably only 4,500 are really what we call investable suburbs. We don't want to be in Broken Hill, the back of Burke. They're no good to us. We really want to be in those suburbs that are at least close to all the things that tick the boxes: infrastructure, employment, etc. Of those 4,500, probably only 163 on average will come up as strong growth suburbs, meaning that they tick all the boxes for these things to happen at that point in time. You've got rising rental yields, then sales are increasing, days on market are starting to fall. But then we overlay another layer on top of that and say, is this a long-term trend that's happening, or is it a flash in the pan? And I think one of the perfect examples here is looking at something like Moranbah, a mining town that took off, or even Port Hedland, which a lot of people have amazing stories about it, how it really had this massive trajectory. Now that would have shown up as a strong growth suburb. The question is, do we want to invest in it? Because it's basically a one-trick pony. It's one town in the middle of nowhere, resting on one industry, and if that industry will fall over tomorrow, you really wouldn't have a lot to save you. And as subsequently, that's what we saw happen with the mining boom and bust. So we're looking at these properties with a layer of intelligence over the data to say, is this something that is going to be sustainable for the long term as well? And that takes us to about 28 suburbs, give or take. Sometimes it's 32, sometimes it's 28, depending on what comes up. So we're really refining down into, from 15,000 suburbs, the program is crunching this data down to about 28. Now, what we found over that time is that since 2015, our clients in these approved locations have outperformed the market by 30%. So it's quite considerable. To show you a graph of this, this is what it looks like. So you can see the residential indexes line across there in the white. This program back-tested over this time has outperformed the market by 30%, which I think is really hard to beat. We always prided ourselves on the level of research that we went to for clients to look at particular growth suburbs. But this just takes it to a whole new level in terms of its analysis and speed about what's happening in different markets at different times across the nation, which I think is one of the most powerful things that we're getting to today, because it allows us to move into different markets based on different budgets. It's not just about, going into markets that are $1 million to $1.2 million. We can now look at markets that are 300 to 400 or 500 to 700. So it's a lot more flexible with what we're looking at. So to move on to the second part of this analysis, once we had the suburb selection, then we needed to look at the street. And what we found was there were certain parameters that were coming up within the suburb that would make better buys if you bought in particular pockets. And you probably know yourself, Anthony, if you're living in a particular suburb, there's probably a good side and a bad side, or there's areas that you might stay away from. This picture on the screen is actually a perfect example, and that's actually a real life picture. It's of one of the suburbs in Brisbane, which is Stafford, and you can see those red marks there. They're actually public housing zones. So we can earmark where almost the good part of the housing is and the bad part. And this is really insightful because what we found, there were suburb sweet spots, and within those sweet spots, there were variables. One of the variables was that there needed to be less than 15% public housing, right? That's very interesting, I think. The second part was that it had to have strong tenant demand within that pocket, and it had to carry ideal property types within that pocket as well. And I'll get to the ideal property types when we dive into into property selection. But what I mean by that is that if you're looking to invest in the western suburbs, Penrith, etc., the suburbs out there, you probably wouldn't buy a one-bedroom unit, right? That's not suited to that area. Most people are looking at homes, they're larger families, they're probably looking at 3 to 4 bedroom homes. It doesn't make sense to buy into a small one-bedroom unit. But if you were in Darlinghurst or Surrey Hills, where space is very valuable, properties are a lot smaller and you're a lot closer to the city, one-bedroom units are very suitable. And that's what I mean by ideal property types. Does that make sense?
It does. Yep.
Fantastic. What we found was that if you were investing into the suburb sweet spots, we could increase our gain by 21% from properties in the same suburb. So if we identified the right pocket in that suburb, we could get a gain of 21% over the other properties in that same suburb. Now, the third part of this equation is the properties themselves. And the three main things that we found in this was that it had to have the most common configuration. And when I say that, when I remember I talking about the houses and the units before, the most common configuration is it a 3-bedder? Is it a 4-bedder? what has the strongest demand when it comes to sales? Do 4 bedrooms sell the most, or do 2 bedroom houses sell the most? Or is it 1 bedroom units? What also has the strongest rental demand? Do renters demand 3 or 4 bedroom homes, or do they demand 1 or 2 bedroom units? This played a really big part in selecting the right property within that area. So what we found then was that if clients were buying into these particular properties in the right pockets in the suburb that had been approved by the advisory program, over 90% of them in the first year were achieving over 15% in equity gains. Right now, this is a combination of 2 things. First of all, it's a combination of buying under market value, right? Because remember, we're buying into buyers' markets at this time. The market hasn't turned into a seller's market. There is still time to negotiate on these properties. You know, if you try and negotiate in a hot seller's market, you'll get wiped out of the way. It's usually the man with the most money wins, really. And then on top of that, you will also gain on the actual suburb uplift in terms of growth as well. So it was we found it was a combination of, 5 to 10% on each side, where we'd buy under market and then we'd get the market uplift from the suburb growth as well. So if that all makes sense, Anthony, if it's okay with you, I'd like to jump into a couple of case studies here that I can show you. We've been looking at these 2 case studies are actually on the market.
Just before you do that, I thought it might be good to... So in summary, the top-down level is looking more specifically at the suburb, the street, and then the actual properties in a specific street. So you're bringing it down to 28 suburbs, then you bring it down to streets within that suburb, and you bring it down to houses within that street.
Yes.
What, in terms of your property selection, how's that, and you're getting results that are obviously quite compelling for clients, but how's that changed from, say, a traditional way that someone might look for a property using the fundamentals you're talking about, and the way you've changed how you approach things as well?
Yeah, that's a really
before
good
we
question.
get into the case studies.
Yeah, obviously one of the things that we do here is that we're totally removing the emotion out of it, and I find that people probably, even the better investors, the smart ones, they'll pick up on particular growth items, like they'll pick up on those events that I talked about. The new train line going in, or a new supermarket. But most of them will then come back to, well, I'm going to buy in the eastern suburbs because I live in the eastern suburbs. It's blue chip. I know it'll never go down, which is a bit of a myth. And I feel comfortable there. And so they end up investing there. And when it comes down to it, that is an emotional decision. There's no real data that they're relying on to say, yes, this data supports my decision around that. So I think we're coming back more and more to saying we're trying to remove the human element out of it, and saying, even if we know where the light rail is going through to Randwick, is it a good time to buy when the media announces it in the newspaper? Is it a good time to buy when the DA goes through? Is it a good time to buy when it's actually finished? And that's the difference here. You could buy within 2, 3, 4 years of these events happening and still not see any growth until those tipping points occur, where you've got renters moving in that have started to increase sale volumes, and then days on market start falling. And that's the right time to buy, where you're going to get the uplift in the equity as quick as possible. So it's taken it away from a little bit of guesswork around when that growth will occur around these particular items, and taken it down to a real analytical approach with a little bit of common sense around it as to whether that's the best long-term decision for you. Because, of course, we're investing in these things for the next 10 to 20 years. So we want to make sure that it's not just a flash in the pan, so to speak. Does that answer that question?
Yeah, it does. I think it's probably before you do the case studies as well. If anyone's got a question at this point around property investors or any of those fundamentals, just type it through and we'll deal with them on the way through while Josh is working towards his case studies as well.
Yeah, happy to answer anything there as long as it's within my grounds of expertise, of course. So,
otherwise, we'll just move into the case studies.
Fantastic. I mean, I don't see anything coming through just yet. If it's okay, I might just jump into the case studies quickly. We might get through some of that. Now, I've got two case studies here, and let me start with this one first. As you can see, relatively well-presented house. I'm just going to have to move my Q&A box around a little bit so I can see what I'm looking at. But this was, this is a purchase in the metro area. So it is national, in one of the major metros. Obviously not Sydney because it's an asking price of $360,000. But you can see the property itself, obviously, I would say probably built in the last 5 to 10 years, low maintenance, brick home, presents very well, probably rent out quite well. Asking price of $360,000, so very, very competitive price. This has got a buy price on it of $335,000. So this is where we feel we can go into the marketplace today and aggressively push, because it is a buyer's market right now. We can take advantage of that and buy $25,000 under market, which I feel is reasonably good. You don't see that happen a lot in hot markets. Now, the clincher with this one is one of the things I really love about it. It's got a rent of $370 a week. That's a 5.7% yield. Now, to compare that to something like Sydney's growth or even Melbourne, you're probably looking at 3.7 to 4% in those two capital city markets. 5.7 is more than likely cash flow positive. So if you're looking for something that's both within a high growth area and is cash flow positive, then this is where you get to have your cake and eat it too, in a matter of respects. Very, very solid, very affordable. I know a lot of people's budgets have been brought back by the lending institutions right now. So being able to get in for, sub 350 into a market that we see projecting forward very, very strongly in the future, at least in the next 3 to 4 years, at +7s, +8%, I think is a really great prospect. Now, I want to jump into the next case study. This one's a little bit more complex, and if you're looking for something to sink your teeth into from an advanced perspective, this one is very, very interesting. So this is in the metro area, asking price of $445,000. We feel we could probably negotiate at $415,000, given how aggressive we can be in this market. Now, that's under market by $25,000. Now, the yield here is only 4.5%. So let me explain why I see some real value in this. The block's actually 700 square meters. All right, it's quite a large size, even for your larger metro cities. So I'm going to map it out here in this little visual map, and this is not an actual picture of the property itself, but I've used this as a diagram. And you can see here we've got under market, we've bought it at $415,000. The value is $445,000. So we've generated about $30,000 in equity here. The next stage I'm going to do here is I'm actually going to subdivide the rear. Now, this is very achievable. We've done this before. And to do it, it's going to cost me about $25,000. Now, I get an uplift on that of netting $115,000, right? So it actually takes a little bit of value away from the front block, but once it's all said and done, the value rises 140, and I net 115,000 in equity gain just by subdividing the back block off. Now, it wouldn't be complete if I left it empty, so I'm going to put a new house on it. I'm going to build that house for 220,000. In today's market, that same house is worth 430,000. Right now, this is a big jump in equity gain. If you can build at 220 and value at 430, you've got about a $210,000 equity gain on top of that. Then what I'm going to do is I'm left with the front house and I'm going to renovate that. Now it's an old house. I'll probably throw 25,000 at it. I'll gain about 50,000, so I'll probably net 25. Now, if we add all these together, you've probably been doing this in your head. My total cost here is about 685. I think I'd probably struggle to find a decent house in Sydney for that price. But you can see that the equity gain after doing these relatively simple, or I should say relatively simple, but not always easy gains in subdividing, building the new home and renovating the front one, I've gained about $380,000 in that uplift. Now, in terms of its growth market potential, this is what we're looking at. Now, I'll just move, so I'm moving my Q&A boxes around here. First year, 8% prediction, second year, 6%, and third year, 6% as well. So very, very strong market we see moving forward into the following years, but it's very difficult to get past that equity gain of $380,000 by manufacturing the growth in itself. And look, even if that market flattened out and we didn't see growth, the fact that we can manufacture that equity within those strategies themselves is a great boost for buying a property like this. Now, I will preface it and say it's not for everybody. This is what I would call a reasonably complex strategy. It does require a little bit of hands-on attention to make these things happen. But, you know, with the risks come the rewards as well. So, Anthony, if it's okay, do you have any questions around that at all?
Yeah, look, I think that run through you've done gives us a great understanding of some of the technology, I guess, being used by professional buyers agents such as yourself in identifying specific blocks, and the tools you're using and breaking it down from the suburb to the street to the actual home within the street using historic data as well as events and the timing around those events, which seems to be the difference, seems to be using a lot of that technology and data to identify that. From a layman's perspective, if we're not a professional buyer's agent, not using a professional buyer's agent, what are some of the things that from this technology that can be applied by a layman in terms of in their search for an investment property, if they're going to go it alone, if you like, to find a property?
Without using this sort of data?
Well, just in terms of if you had some tips for investors, right, who aren't using a professional buyer's agent who's got access to that sort of stuff to source the right property, what tips would you give investors that you've learned from that technology, but also just from your experience?
There's a lot of free information online, probably a lot more than people realise in terms of what you can access. I would say next to the research group that we're now coupled with, we probably had 50% of our data coming from free online sources. That was quality data everybody relies on, but you can just pick it up for free. Like, vacancy rates are a key one that we look at. Now, SQM provide those for free. You can just go onto their website and find it. But there have to be critical elements that you're looking at when you're analysing areas that fall back on data. Now, long-term and short-term growth data is key to that. If you can get a subscription to things like RP Data or even Australian Property Monitors, Price Finder, they provide some really great data. On the House, I believe, is another great resource you can use. But there are usually 5 key things that we look at, and just rattling off the top of my head, short-term and long-term growth within a suburb is essential. Vacancy rates within a suburb are a great measure of the rental market and the health of the rental market at the time. Other things, the rental yield, how long it takes to sell on market, which we call days on market. And then we're looking at other tiers, like we're looking at the number of owner occupiers in that space. Is it over 50%? Are they predominantly renters or predominantly owner occupiers? We're also looking at the income within those things. So what's the general income? Now, you'll find that some of these larger sites provide this sort of data. So On the House is one. Domain is really catching up in terms of the free data you can get. And if you go on to the places like Domain and realestate.com, they're adding new tabs all the time. So you'll go on to them, and if you click on research, you can actually drill into a lot of these suburbs. Realestate.com is actually quite insightful, because the things that I was talking about before, where we were talking about the right configurations, you can actually go into particular suburbs for free. You can look it up online, and they will show you the demand for 4-bedroom, 2-bedroom, 3-bedroom homes in that area, and they will show you the graph over time. So with a little bit of elbow grease and some grunt work, you can actually find a lot of this data for yourself. Probably what it comes down to, Anthony, at the end of the day is, do you have the time to do it? And can you piece it together to create a story out of it that actually makes sense to you? So you're really looking for something that's going to be sustainable in the long and short term, that doesn't have any risk around it when it comes to renting the property out, is relatively low maintenance. And then, of course, the things that we do on the ground, which everybody can do, is you go out and inspect the property thoroughly. You do your due diligence around the building inspections and pest inspections, etc., to make sure you're getting what you pay for.
Yep. So, Josh, we've got a question here around which we might cover off on the way through, with my next bit. So, do you want to just tell us how a professional buyer's agent applies this and works with your clients? A number of clients have worked with you and get value from the services to ultimately find that property. And we can also cover off the question in here about whether you also manage subdivisions and renovations as part of that business model. But do you want to just cover off a little bit how you work with clients and the role you play?
Absolutely. I will just jump in and say, Glenn's asked a question here around, I'm pretty sure it's around case study 2. Can you provide stamp duty estimates and capital gains tax estimates to be deducted from gross profit and equity figures as overstated currently? So we have to be really clear here. We're not trying to inflate this to be more than it is. Of course, there are costs associated with getting into projects like this, stamp duty being one of them. And if you calculate stamp duty, and it varies between states and it varies between price points as well, to be accurate, I would allow 4% of the purchase price to be allocated to stamp duty. Generally, I allocate about 1% of my purchase price to other fees, including legals. So if you can take that off your purchase price analysis, that's a good start. Glenn, you've also mentioned capital gains tax. Of course, capital gains tax is only applicable if you sell the property. One strategy you could undertake here with this equity gain, you don't necessarily need to sell. You could refinance and unlock that equity to be used for further purchases. And in no way am I saying that this is this equity gain is a net gain for the investor. It's obviously not. There are other taxes to take out of here. If you did sell, obviously you'd be up for capital gains tax. You'd also be up for sales agents' fees. So it's not without its additional calculations. But, within these models and case studies, we try and keep it really top level, just to give you an indication of the sort of gains that you can make. And, if we were talking about a $5,000 gain on an investment, I'd probably say, yeah, okay, we're going to be cutting it fine with our net profit and loss. But I think here, the bigger picture is that, pursuing a strategy like this can yield significant profits if it's done well. Anthony, to jump into your question, mate, I'd love to talk quickly about how we can help.
And maybe cover off that other question as well that we have.
I will about the managed subdivision from Dom.
Yep.
I don't know how many people have been exposed to buyer's agents or using a buyer's agent in the past. but this is a quick rundown, in a couple of minutes, that this is how we work. And effectively, this is the picture of what happens when the buyer goes out into the marketplace today. The buyer's on the left-hand side in the black. They go up against a professional real estate agent who's in red, and they've been represented by the vendor at the back. So the vendor has professional representation to get them the best price possible, which makes sense. But the buyer has to go head-to-head with that professional sales agent. Now, what we do is we come in and we effectively stand in for that buyer, and we represent them in the negotiation to get them the best price, and often just to find the best deal in the first place. And it's really kind of summed up in three moves in terms of what we do. The first is to identify the right area to start with when we're investing. We then identify the right property within that area. And then, of course, we're negotiating for the right price. And that's pretty much our service in a nutshell. Of course, we can go a lot deeper into that. But I think it's also important to outline here that we are part of a holistic service. It's not just about buying the property and getting the transaction. And I think this next slide, Anthony, I think is part of how we work with you. Do you want to sort of intro this, or would you like me to explain how this
works? So I guess part of investment property is a complete solution, and that's part of what Josh and I have built with a team that we've now built to give a holistic solution around the finance, the property advice, the conveyancing, the building inspections, the strata inspections, the valuations, and the property managers. So we've really built a holistic solution for our clients and partners, that we pretty much take care of each of those facets of purchasing an investment property, and look after each of those areas for our clients. So again, we keep it high level. It was more about the investment strategy, but I guess it's worth touching on that it's not just about getting the finance, then identifying the property, finding the property, and negotiating. We've also built a solution that incorporates all the other bits in between in terms of what we can see on the wagon wheel there.
Fantastic. And look, I think this is probably a good segue into Dom's question about whether we manage the subdivision and renovation, like I mentioned in case study 2. In short, Dom, we don't. We're very good at what we do, and we specialise in that. And we farm out the rest of those tasks to other people who are very good at what they do, and including Anthony for lending. But then it comes down to the right property manager. It comes down to the right builder, and obviously, we go through town planning to get the subdivision. Now, what I can say to you is that I work pretty closely with my clients personally. That deal that you saw in case study 2 is actually a deal that I'm undertaking personally myself as well. So any clients that do come on board with this sort of thing, they just kind of piggyback on what I'm doing and get my contacts effectively. So no, I don't manage it personally, but you will have access to my contacts along the way, in short. So really the question is really where to from here, Anthony, and I think from what we've seen today, there's a lot of really compelling numbers in here that I hope are opening for a lot of investors that are on today that we're talking to. I would say that if you are thinking about doing this or know somebody who's interested, I would say talk to Anthony first for finance. This is a critical step. Generally, we want to make sure that you can first of all get finance in this current marketplace. And of course, even the best of us are taking extremely long to work through the process with the banks of actually getting approval. The banking requirements now to get funding, it can be challenging at times, and what used to take 1 or 2 weeks is now taking 1 or 2 months. So working closely with Anthony is critical there, and then basically scheduling in a time with myself or one of the team to go through a strategy session, really get clear on what the goals are that we're trying to get in place, what the best requirements are for you, and to make sure that, you know, when we go out looking for property for you, that it's actually going to suit your circumstances and put you in the right stead moving forward. Anthony, do you have anything to add there, mate?
Not really. No, I think you've covered that off. Things are just taking a little bit longer through credit and structuring facilities at the moment, but I think you've covered all that off, mate.
Beautiful. Mate, look, we're coming up to the 50-minute mark. I know I probably mentioned it was around this time, and I will move to Q&A. For anyone on the line right now, of course, both Anthony and I are available for Q&A. I'll throw you there under the bus there, Anthony. So, mate, if you've got,
if you've got
any questions
anything
for me or any of the other people do, then fire away.
Sure. We'll just give everyone a minute or so to see if they've got any questions, but I think that was a good run through, and hopefully everyone got something that they can apply to their particular situation or their clients.
I actually have a question for you. Obviously, we've seen the Royal Commission coming out, you know, supping the hands of the banks a little bit, and the lending criteria really tightening up from the bank's perspective. Now that that's sort of passed, how are you finding that that's impacted the market, if any, and what do you think the bank's sort of outlook is in terms of lending to the market? Because I find that tight credit right now is probably the one thing holding a lot of people back. Would that be correct to say?
Yeah, so the main elements, I guess, are it's taking longer to get through credit, and people are sometimes finding that they aren't able to get as much approved as they may have thought, or they may have been able to 6 or 12 months ago, because some of the criteria within the credit environment has also changed. There's a lot more forensics, and there's a lot more hurdles to get over, I guess. So a massive part of what we do is finding the right provider from a structural perspective, as much as from an interest rate perspective, to put the clients with. And that's where a lot of our work is, to make sure when we put something in front of credit that it goes through credit as we thought. But yeah, look, I think it is still a competitive marketplace out there. There's some really good opportunities within the market in saying that. Credit has tightened up, but it's the providers are still very, very competitive around interest rates and around some of the offerings they've got as well. So they're feeling the slowing of the market and the changes as well with their volumes and the business going through them as well. So they're putting out some pretty good offers for their clients and to attract new business. So it's a bit of it still isn't quite settled down, that whole market yet, and I think we'll see some of those credit tightenings ease back and find a little bit more balance over the next 6 to 12 months. But at the moment, yeah, it's taking a bit longer, and people may not be borrowing quite as much as they thought they were able to, or you know, so everyone just needs to give themselves a little bit more time, understand their capacity, and that then gives them the opportunity to go finance ready to their purchases, or to their auctions, or to their open days.
Now, I saw Bill Evans, from the economist from Westpac, predicting 2 more rate falls this year alone. He was predicting a rate increase last year. Now he's predicting 2 falls, which tells me that you know, combined with maybe a loosening of credit in the next you know, in the second half of this year after the elections pass, we may actually get a rate fall, which could certainly stimulate the market a little bit more. Is that how you see it?
Well, if I knew that, it'd be great. Look, it's hard to predict. There's been a lot of out of cycle rate movements, is the truth. A number of providers, some providers have put their rates out. Some providers have put their rates up. Some providers have dropped their rates. So they're managing their volumes, and there's been out of cycle rate cuts. So a bank yesterday put their rates up 40 basis points. Not one of the majors, more of a minor bank. So there's not only the RBA managing the rates, there's also the costs of funding and that's been impacting rates out of cycle. Will they go up or down? I don't know, but there has been some talk recently, and you read different parts of the media, and Bill Evans is thinking maybe there'll be a drop. Others are thinking they'll stabilise, and others are saying maybe they'll go up. But some of the provider movement is inconsistent with what's coming out of the RBA. So again, it's about, we're across that, but we are seeing, movements that are out of cycle or out of sync with the RBA, and that's been more driven by costs of funding.
Okay.
Mate, we've got a couple more questions there if you want to run through those.
Dom's shot through a couple. First of all, what does a service cost? Good question. We didn't cover that off here simply because we offer a couple of, or quite a few services ranging from negotiation only and representing the client from the negotiation point onwards and managing that process, all the way through to, your full end-to-end service. Now, that starts at around $3,600 and it goes up to, $15,000. Well, it depends on the price of the property. Sometimes it's, tens of thousands if you've got a, multi-million-dollar property that we're dealing with. So it's actually better to have a conversation in person around what you're actually looking for, because we then tend to craft a service around it based on, the 3 or 4 services that we've got and the price point that you're looking at. So it's very much dependent on a couple of things there. So I hope that helps to some degree. Dom, you've also asked, are your target areas evenly spread throughout Australia? Because some markets, obviously in down cycles, could skew our results over time, no doubt. My answer in short is yes, they are evenly spread, but generally tend to cluster around the major metros and the key regional centres across Australia. But it is a national thing. So we are, covering everything from, Sydney to Perth and Darwin to Adelaide kind of direction all the way down to Hobart. But then obviously there's only so many investable suburbs that we'll look at. And from there, only so many that will actually tick the growth hotspots. And they do tend to move around the country based on the growth cycle that they're going through at that time. So it does, the markets that are in down cycles don't tend to show up as key markets to get into, if that makes sense.
All right, so we're just coming up on the hour. So thanks for coming along today, Josh. I haven't got any more questions in my panel. Are you covered all yours off?
I believe so. I'm looking at chat and the Q&A, and I think unless anyone wants to throw in a last minute one, I think we've covered most of them off.
So yeah, thanks everyone for attending. I hope you got something out of that, and Josh for some of those insights. And if anyone has any further questions or follow-ups, or would like me to connect anyone with Josh, just send me an email or give us a call. And I hope you enjoyed it and got something out of it, and we'll catch up again soon.
Mate, thanks everybody for having me.
Cheers, Josh.